Hi everyone, this is Jason Burack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He operates a private mining company. He's a gold and silver consultant in the industry, and I would definitely consider him an expert. He's joining us, I believe, from Vancouver, Canada. David Jensen, thank you for joining me again.
My pleasure, Jason. Good to be back.
Now, David, you sent me your very interesting analysis of the global economy right now. You think basically no matter what the central banks do, you don't think that they can fix the economy. Why do you think that is?
Well, they're using the same tool that got them into trouble, which was excess credit. We have a debt-based money system, and Mark Faber sums them up quite well. He calls them the money printers, and that's what they are, and that's what they know. The problem that we have is that excess credit creation has, over the last several decades especially, created an untenable economic structure and a massive debt burden now. From the Austrian economics standpoint, the interest rates now are very low. We have the zero interest rate policy. And the Austrian school warns that when you have a low interest rate, as opposed to allowing the bad credit to clear and the economy to heal itself with the slowdown, if you try to just juice it higher, you have the remainder of the debt and the inefficient enterprise as a drag on the economy. But the other thing is that you actually need higher interest rates to heal the economy, because the higher interest rates create a hurdle. And this hurdle, basically, the higher interest rates specify that or result in that nothing gets financed unless it gives a quick return on capital. So it is this, the high interest rates of the 1980s were a very difficult and painful time, but we did have the economy heal after that period. And the reason is that things that got financed were things that could generate quickly, could generate jobs and generate beneficial economic activity. And so this concept from an Austrian school perspective is called time preference. And when you have 0% interest rates, things can become financed that might only get out to market in 5 or 10 years. Whereas you have, a 5, 10, 15% interest rate, you have in increasing terms things that must give a quick return on their capital or they won't be financed and come back into the economy. So that first reason is the reason I think the economy can't be healed. And the second thing is that we know from John Exeter, E-X-T-E-R, he passed away in 2006, and he was a former senior vice president of Citibank, and he was also with the New York Fed. But he warned Paul Volcker, who was the primary architect of disconnecting the U.S. dollar from gold, that doing so would result in a massive debt bubble, because with a debt-based money system is ultimately manifests itself as debt, can be created without limit. And ultimately, that results in an enormous debt bubble. And guess what we see around us? We see exactly what John Exeter warned us about, which is this enormous bubble which weighs on the economy. And if the debt creation or the money printing continues, will lead ultimately to a collapse of the debt-based currency.
Higher interest rates, that would allow better allocation of capital. It would force the banks or other inefficient business operations to go bankrupt, and bankruptcy is part of an efficient market, a free market. Can't have capitalism or free markets without bankruptcy, so the people who made, bad investment decisions with their money, the people who had savings and didn't make the bad decisions, they would be able to buy the assets for pennies. Maybe we're seeing that in small amounts in the private sector for a small businessman, but for, government-favored industries like the banks and other larger crony capitalists who have protection thanks to lobbying and stuff, we're not seeing that right now.
Yeah. And I believe, with this Fed talk now about raising interest rates, they're actually being forced to do so by the bond market. We've seen the 5- and 10-year yields going up since last year. And I believe that the Fed doesn't want to raise rates, but it's forced to appear to want to, so that it's not realized by the market that it has actually lost control of the market. So this is where we are now, is I think that the Fed is trying to maintain the too big to fail banks and the financial system, as opposed to restructuring the financial system and perhaps the outstanding debt in some kind of an ordered restructuring system program. And what they're doing is continuing with a failed policy to the point where we have failure. And I believe now that the financial markets have been juiced so far out of reality to what the underpinnings of the real economy is, that they are now on their own starting to cascade down. And I think we're seeing that in the markets today, both in Asia, Europe, and in North America. So Today was a big surprise to me, very much a surprise, given the bounce that we'd seen in some of the other European markets last night. And today's the 25th of August. So we'll see where it goes. But for sure, when we look at some of the macro data in Europe and China and the U.S., we can see that the economies, as opposed to being healed and in a recovery mode, are really, in a very burdened and in a sickly state.
Agree. The real economies are not doing very well, whether it's China or Japan or Europe or the United States, but yet we see government statistics saying otherwise. So I call it stagflate and lie, where they have to say that they're fighting deflation. The Keynesians have to say they're fighting deflation, but that gives them a cover then, basically create almost as much currency as they want, at least to juice the asset prices and knock interest rates down and force bonds and other asset prices higher for collateral and other reasons. But, it looks like China, the market's calling them out on bad economic data. But the funny thing is, guess where the PhD economists who are Keynesians learned how to make all this bad economic data from that they saying is a lie? They learned from United States schools and on Wall Street. So
yeah, and I think we can see that in the macro U.S. data, just even looking at just the unemployment rate, for instance. And, Rick Santelli often mentions is that the U6 unemployment rate, which was calculated in 1980, is running about 11%. And the numbers that we're getting from the Fed these days, or the Bureau of Labor Statistics, is that it's really 5.5% unemployment and recovering. And so there's a huge difference, a gulf between those types of numbers. One is indicating that the economy is very sick. And when we can also, Jason, see that in the job participation rate, where we have 93 million adults not in the workforce versus 78 million in 2008. So you've got a 15 million person gulf there of those who were employed then versus those unemployed then versus those who are unemployed now. So I don't really see a recovery in that, or in the additional 19 million people receiving food stamps now versus 2008. So things don't look good to me. And I think that we've seen all kinds of indicators of an onset of a decline in the factory orders versus inventories dropping, and a spiking of the inventories, over the last 6 months now. So things don't look like they're in recovery mode to me, and I think that the market is finally responding to that now that there's not this QE driving margin debt and blowing up the markets.
They're talking about deflation right now, maybe in asset prices, but I mean, for in the real economy, in my bills, I don't notice any of my bills going down. So,
no.
Obviously, it's about the money supply. For the Austrian school definition, it's a decrease in the money supply, and maybe the money supply is not increasing at 30% per year or anything like that. But with the Chapwood Inflation Index in cities like Washington, D.C., around there where I live, it says the inflation rate in the United States has been double digits for the last 4 or 5 years, whereas the CPI says it's been 1 or 2%.
I've heard the expression biflation, which is the things that are essential for life, such as shelter, food, and energy, ultimately as a group are heading higher. And the things such as copper and industrial goods, for which there's an oversupply with a declining economic output, they do show the decline in price from the oversupply that's there. And even in Europe now, we're seeing that they have 49% youth unemployment for those under 25 and 44% unemployed in Italy. So things aren't looking good, and there is a decline in consumption of the West. And certainly we've seen the crack in the Chinese markets, where they've lost, I believe, of the order of $4 trillion now in market cap, indicating that economy is not well either.
This is all central planning. The worst thing you can do to misallocate capital and also distort markets is to start playing with the interest rates and the cost of money. That's the thing at the top of everything else, and then it just sends bad signals. You have auto companies bragging about here in the United States they gave out loans to subprime borrowers, and you have all these universities. They're building brand new football stadiums and all these facilities for students, and they can perpetually hike the tuition costs every year. I mean, these are all credit bubbles that have been created with fiat money.
Yes, and what all of these economies share is central planning of the monetary system, of the money supply, and in a related feature of interest rates. And central planners cannot know what the right rate of interest is. Only the market can determine that. And what they've been tempted to do is to continually lower the interest rate to support the ever-increasing debt that exists out there as a function of GDP. So, we've now got this debt, which is just crushing the economy. We've got artificially zero interest rates trying to reflate the consumption bubble, which we know from an Austrian perspective can't be reflated. And we've now got things like coal, copper, and oil are all at 6-year lows. Pardon me. So we're seeing things like oil. I think it hit $38 yesterday. I think it's up marginally today. But tremendous oversupply of these industrial commodities, signaling that there's a drop in demand. And this all really started to show up in the fall of last year.
Yeah, I agree with you on the base metals, although with oil, if you read the papers in the Middle East and the evidence coming out, and I also had another guest on last week, Dr. Kent Moores, who goes to London and Dubai and Abu Dhabi and stuff for oil visits. He says that OPEC is intentionally shorting the oil price, and the Saudis just borrowed a lot of money on the bond market to keep the oil price low, so they can keep paying their social programs. So that might be a little bit separate, more where demand hasn't completely fallen, because I can cite all these car sales that are still increasing all over the globe, although they're not as large in terms of sales growth. But the other ones, I agree, there was massive overcapacity, massive oversupply.
Zero Hedge had an article they posted on the weekend, and it indicated that the demand factors were at least 5 times as great as the supply factor. So it was a decline in demand that had 5 times the bearing on the current price, as opposed to an increase in supply from Iran and all these other, the Saudis and everybody else. So I think that at exactly the wrong time, there's been an intentional injection of oversupply into the market at the same time as the overall driver, which is demand, has dropped off at the margins enough so that you have a very large drop in the oil price. So I agree with you, both factors are there, but I think that we've got really a drastically declining global economy here that nobody's talking about, that most people can't see because they're looking at distorted statistics. And there's hope for a recovery of the stock market, and I just don't see it coming.
Yeah, not unless the Federal Reserve or these other global central banks go in and either start rapidly devaluing their currencies, which would probably create a short-term boost maybe in the asset prices. But I mean, that's not real productive economic growth. That's just goosing the asset prices higher to make banks or other holders of the assets look less insolvent. So we're at a stage here where the fundamentals of all these markets were just not justified with the asset price valuations, and yet they just kept going higher for years and years and years after 2009. Yeah,
the emerging market currencies have also had a very, very large drop over the last 8 months. The Chinese RMB has been pegged to the U.S. dollar. And as these emerging market currencies have dropped off, they've already experienced tremendous food price inflation. And I think what we would see here is that if there was an attempt to rapidly devalue our currencies, that it would drive even higher the inflation that is being seen in these emerging market economies. And also, China now has seen a 50% increase in the price of pork, which is one of their staples. They're already seeing in some food groups that they have very large food price inflation. So it's very, very difficult to do these very large, restructuring of exchange rates without having very real impact on the critical goods in the economy. And I think that's, it's again, when you get into the central planning, you work your way into these untenable situations, trying to manipulate yourself out of a situation which is really, at its core, it's what the Wall Street Journal estimated to be $220 trillion of global debt at the end of November 2013. And just for a sense of perspective, that's about $120 trillion more than the long-term sustainable amount of debt, which we've seen historically. So what they need to do is address this outstanding debt to write it down. And at the same time, I think we've got to get back to a sound monetary system and away from central planning and the regulatory capture that we get with that, and the bad ideas such as Alan Greenspan and Ben Bernanke have had, and get back to a much more sound footing for our economy. But it looks like they're so beholden to the financial interests who benefit so much from the current system that the reform won't happen. The citizens are uneducated and uninformed about what is really going on, and we appear to be heading off a precipice now in the stock market, and And as John Exeter pointed out with his inverted asset pyramid, he showed a structure of the most unstable to the most stable assets. And he showed how the destabilization would start in the most unstable assets, such as derivatives, and move down through the asset chain, ultimately ending in gold, which he called power money because it was nobody else's liability. And that's the ultimate asset, he said. But it looks to me like we've, in 2008 even, we had these derivatives destabilized, and we've had money printing to try to stabilize the world's financial system. And, we've moved down now to the government bond level, I believe, of where we're starting to see yields go up. And they would be the third last asset class to be destabilized. Next comes paper money itself, where people jump out of government bonds when they realize printing is unlimited, money printing is unlimited. And they end up finally in gold, or I would argue silver, which is also a multi-thousand-year monetary instrument versus 100 years of Western money printing.
Yeah, I would agree with you. Central planning definitely does not work. But, the government has bribed citizens with their own money. And we have a situation now where so many people in the United States and other countries are getting government benefit checks that, they don't want to vote these things away. And, in fact, the politicians now, the ones who get elected, David, especially in the United States, tend to be the ones who promise more goodies for free.
Yeah.
And then you add in the fact that, most people, they're so busy just working a job just to survive or keep their head above water in terms of debt payment or to put food on the table for themselves and their family and stuff. And then they have bread and circuses with all these distractions, whether it's, sports or celebrity gossip and all these other, reality TV and all these other things.
Mm-hmm. Yeah, it seems that, what we have from our current crop of politicians, they tend to respond to crises. And the crises are often caused by their own bad policy to start with. And when they address the crises, they portray themselves as heroes, as opposed to admitting the fact that they basically sent everything sideways to begin with. And I agree, Jason. It's people aren't in the mood to hear that things aren't going well, even though I think they need to. And the politicians are. They seem to be the last group out there who are willing to, other than individuals like Ron Paul, for instance, they really seem unwilling to address the tough issues and to really speak truth to everybody.
Yeah, Peter Schiff's, I don't know if you're familiar with him, but Peter Schiff's father, Erwin Schiff, used to say the government breaks your leg and then hands you a crutch and acts like it didn't break your leg.
Right.
So, this is a situation, with handing out all these freebies and central planning and having a central bank and a welfare warfare state and, all these corrupt crony capitalist deals with unbidded contracts and corrupt politicians. This is all from government power being way too big for right now.
Yeah, and regulatory capture, which the government is the ultimate regulator, and they're basically captured.
Well, we had a successful economy long before the
Sorry.
Well, we had a successful economy, David, long before there were a lot of regulatory agencies. Before the Department of Education and all these other regulatory agencies, we had successful companies that were some of the best in the world and very efficient and things like that. Now, obviously, they could have cleaned up the environment better and things like that, but, that's politicians not raising the price on water, capping the price on water. That creates shortages and things like that of fresh water because they're not allowing the market to set a price for water. There's no profit or economic incentive then for an entrepreneur to go invest in new technology to go clean up the water or the air and the soil and things like that, in my opinion.
Yeah. Property rights do result in enforceable property rights do result in things like lower pollution. It's when there's no real cost to running a polluting industry or a polluting automobile that we tend to have these things go to the excess. So if there was a market pricing for these things, we would have far less of these problems than we do now. The issue that we have now is that government set the regulations, and the regulations are set by revolving door government officials who come from the industries themselves who pollute, and there's very, very little consequence in terms of the costs to individuals or society versus what the polluters pay nowadays, for their antisocial activity.
Yeah, I mean, I know entrepreneurs like in the water cleanup industry and stuff like that who have great technology with algae cleanup and things like that can clean up the water, frack water, and all this stuff really easily.
Right.
But they're not booking a lot of contracts because the municipalities and things like that, they're not allowed to raise the prices.
Yeah.
So it seems like, a chicken and egg problem. It's a head scratcher that, we should just raise the prices and we'll get the investment in the technology we need to solve the problem. The private sector and entrepreneurs solve the problem.
Yeah,
but
if you had enforceable property rights, individuals who were or who were injured or experienced damage either on their person or through their property would have the ability to recover from the polluters and really stop these destructive practices. But we just don't.
Well, it's also the progressive politicians, too, who say that, the poor can't afford the extra $10 a month or something increase in the water price.
Right.
There's a lot of them out there who say, you can increase the water price even $10 a month more. The poor can't afford it.
Right.
So we can't do it.
Yeah, but then you get Nestle now, was it 28 million liters of water, or gallons of water, pardon me, they paid about $500 for in California.
Yeah, it's hypocritical shit because pardon my language, but they probably bought off a couple politicians, right? Probably wrote a $5 million check here or there or something like that to a PAC or super PAC or something.
Right.
Yeah.
Well, Donald Trump says he gets results from giving his money to politicians, so I don't see any reason not to believe him.
Yeah, I mean, I believe Trump. I think he's just using a lot of populist rhetoric right now.
Sure is.
He acts kind of like he's libertarian. He even went to Freedom Fest and spoke there, but
Yeah.
he's obviously not a libertarian. He seems to be like, this is a little off topic here, but he seems to kind of be like the establishment candidate that acts like he's anti-establishment because he repeats all these phrases, that some libertarians and people who are angry at the status quo use. But a lot of his policies are not really that much different than the current ones.
No, I don't see going back into the Middle East and seizing oil assets as particularly libertarian.
Or trying to get Mexico to pay for a whole wall.
Yeah.
I don't know how he's going to do that one.
No,
well,
it's entertainment for now.
He may win though because he has a good act. He has a good act compared to the rest of them. He at least has some charisma and some confidence, and people recognize his brand because he's famous and rich.
Yeah.
Well, I want to transition to gold now, David.
Yeah.
On the last interview we did, we didn't get a chance to talk about the World Gold Council, and you wanted to. Now we saw articles come out in the last couple weeks talking about the World Gold Council, how they said Asian demand is down, and we saw it all over CNBC and stuff. And I was just scratching my head. We look at you and me look at numbers elsewhere. Why do you think the World Gold Council is not doing good research?
That's a very good question. They're taking more than $100 million a year out of the gold industry who finances them, and their numbers are they're not even abysmal. They're all, in my impression is they're kind of a fairy tale.
Propaganda? Question mark?
Yeah, but they're really they are a fairy tale in terms of what real demand is. The numbers, for instance, in the last month in July, the numbers for which we have data from the Shanghai Gold Exchange, they've seen a withdrawal from the Shanghai vaults of 302 tons, and in the first 2 weeks of July, they had more gold withdrawals than the COMEX sees in an entire year. The Chinese gold demand through Shanghai, which is primarily retail demand, is tracking now to be over 2,500 tons this year. And if you throw 1,000 tons from India, India is almost running double of what they were last year. We're over 3,500 tons of consumption this year from those two countries alone, and global mine supply is about 3,000 tons. So I don't know where the World Gold Council gets their numbers. They get some of their data from GFMS, which is part of Thomson Reuters. If we do some research on Reuters, that they have acted at different times as a propaganda arm of the UK government, and this really looks to me more like propaganda than it is real distilled hardcore analysis. So I think the World Gold Council, I think the mining industry needs to look at what exactly they think they're doing when they're taking shareholder money and they're promoting statistics which indicate a dismal situation when we have really the polar opposite in terms of consumption of the physical metal. Not the 200 million ounces a day that's traded in London of paper, but actual physical demand from markets like Shanghai, where to write a contract, a 1 kilogram contract, you have to actually deposit a certified serial numbered bar that has come from a registered refinery at the Shanghai Gold Exchange. There's none of this writing paper contracts and then settling them if you get asked for delivery. So yeah, there's tremendous questions in my mind, and looking at the history of the World Gold Council and Harry Oppenheimer, who is really a anti-gold money advocate, he underwrote the start of the World Gold Council with a $25 million check. He said that gold money was for people who are too stupid to recognize the benefits of paper money. I'm looking around and I'm not seeing very many benefits of paper money right now, and I'm not seeing very many benefits of the research coming out of the World Gold Council for that matter either.
That doesn't make a lot of sense to me, why someone who hates gold would start a research group about gold.
Well, World Gold Council have focused their research over the years. If you look at it, they talk about jewelry. And so what they've done is basically disconnected the people that read their papers and the mining industry, for that matter, the focus of the mining industry, from understanding the real monetary role of gold, and focus it on the jewelry industry. So it's a very helpful way to nudge people in the direction of information which distracts them from an alternative to the government-created money monopoly that we use right now.
Yeah, it sounds like Coos Jansen of Bullion Star maybe should get some of that research money, or maybe someone who does similar research to him. Now, I know some of these larger entities like Goldman Sachs and GFMS, some of these guys are going to Coos, at least talking to him, but we're not seeing his numbers and his research showing up in their reports in public. So it's just kind of a head-scratcher to me that we know for a fact that, they're looking at these other numbers and they're not incorporating them. So there's something afoot here.
Yeah, well, I think in the end of all this, that the focus on the paper pricing system in London and the distraction away from the monetary and the savings aspect of gold and silver, it's going to result ultimately in the gold leaving the West and migrating to places where there are real exchanges where they actually trade the metal. And I don't know if you've seen, but the Bank of England has announced that on November 11th they want to have a conference on creating real markets. And they're an interesting group, first of all. The Bank of England, they run a monopoly on setting the interest rates. And the other thing is that they've been involved with the London bullion market, which is where the 80% of the world's physical gold is traded in terms of ounce volume. It's not real gold, but it is the premier price-setting platform in the world. And the Bank of England has acted as a market maker in there, providing these gold plugs from some of the gold that they hold for primarily from other nations to maintain the gold price. But I think we've gotten to the point, and I certainly have gotten to the point personally, where I ignore the daily price of gold and where it's going in terms of knowing that there are thousands of claims out there for every ounce that's available. And I think we're getting more and more now as we see these John Exeter's pyramid and the destabilization of financial assets and the migration down that inverted pyramid, and knowing that it's going to end up with a panic in the markets for assets which don't devalue. And I think the critical thing now for people is to try, as difficult as it is, to ignore the day-to-day price, because it's just a number. The issue is ownership and control of the ounces, and I think that's where this all ends up in the end.
Now, do you think the COMEX and LBMA, since they're a lot of also paper markets, there's a lot of hedge funds and investment banks and things like that doing leverage trades that actually don't take delivery, can they actually really default, or do they have so many laws set up and things like that where they can take out a GLD and SLV, or they can cash settle, or they can say, you know what, you have to wait 6 months to get your metal, you have to pay all these extra fees and things like that?
Yeah.
Can they actually really default then if they don't have to deliver that much metal?
Well, the COMEX rulebook, for instance, if we read through that, has numerous provisions that allow for cash settlement, and the directors of the COMEX just have to make a finding. And there's very little guidance in there as to how they do it. They just make a determination that cash settlement is the required settlement mechanism. So for sure in the COMEX, according to their rules, you can settle with cash, and I believe it's been going on for some time. What's going on at the LBMA, I don't know, because that's an over-the-counter market, and every contract is different. We do know from their own published documents that the primary assets that are traded are unallocated gold contracts, and the unallocated gold, as we know from the CFTC hearings in 2010, I believe, where Jeffrey Christian acknowledged Adrian Douglas's statement that there was hundreds of claims per ounce of gold that's available for delivery. But again, LBMA is an opaque market. It's tied to the Bank of England, and nobody knows what goes on there. They publish very little information, and the statistics they give are slanted so that you would interpret them in a way that gives you. For instance, they post the net settled trading there of the order of 15 to 20 million ounces a day, even though we know that the gross volume, the turnover in that market is more than 10 times higher than that, according to a document which they issued in 2011, which was 1 year after Adrian Douglas stood up in front of the Commodities Futures Trading Commission in Washington at their hearing and said, listen, there's hundreds of ounces of claims out there for every ounce which is notionally being traded, and this is nowhere near a real gold market. So that's what drove the LBMA. It appears to have driven them to coming clean was the fact that somebody from outside the industry was blowing the whistle, and then they put out their 2011 survey of traders and said, oh yeah, by the way, there is 10 times more. There's 200 million ounces a day trading through our facility of gold, and of the order of 1.5 billion ounces of silver trading every day. And these are notional metal, they're digital metal, they're anything but the real metal is how I would characterize them.
Yeah, and aren't Chinese banks joining the LBMA now, so maybe they're forcing more transparency there? But it seems like the volume, whether it's a COMEX, I mean, a billion ounces of paper silver sometimes trades a day. That paper price volatility really hurts the actual producers of the metal, the silver miners. It's not fair to them at all what happens. I mean, the violent swings in volatility.
No, and the metal is going to disappear from the system, and maybe that's what's desired, and then to structure a cashless society using digital currency with no options for anybody. It appears to be what the Bank of Canada and the Bank of England and everybody seems to be angling towards. But these really are the authors of the demise of the free market system. They've been rigging gold and rigging interest rates as a consequence. When you fix the price of gold, you fix the global interest rates. And guess what's gotten us into trouble is rigged interest rates, too much juice in the system, and financial markets which have just exploded to levels which are a gross distortion of the reality of the real market and the real assets that underlie them. So, I don't expect to get anything, good out of these organizations. They really... we need alternatives. We need an alternative monetary system, and we need an alternative to captured regulators running the system.
Well said. Now, you mentioned gold and silver are manipulated, and I think we've discussed this in the past, and I've talked about this a lot in my podcast and other interviews too. Do you think it's possible then for there to be physical silver shortages then? Because I've heard other experts like Chris Marchese, senior mining analyst of the Morgan Report, and he said basically he just put out an article on goldseek.com and other areas, and he basically said it's impossible for there to be a physical silver shortage. I was curious how you see things.
Yeah, well, it is very possible to have a shortage of silver available to market. What is traded is 1,000-ounce bars of refined silver. There's been of the order of 35 billion ounces of silver mined throughout history. There's about 800 million ounces mined per year. But the paper trading that we see, you have infinite availability of paper metal, and therefore you can drive the price down as low as you want. But what happens is it's a form of price control, as you and I have discussed in the past. And when you have price controls, as we saw in the 1970s in the United States, that the shelves go empty. And so the price is being driven down by the artificial availability of paper metal. And so the price that people who are price followers tend to look to will go down to the level where there are fewer sellers on the market than are needed to supply the number of buyers out there. So, yeah, there is silver above ground, but it's not in a refined form. necessarily, and it is not available to market if the price is artificially low. And I think that we see the all-in cost of mining gold, including amortization of the mining capex, of about $1,600 an ounce, and we've got an $1,100 an ounce price. We can see that there's no gold projects of size that are going to be built, and very much the same with silver. So you can absolutely have a shortage of silver available to market. It doesn't mean that silver disappears into the ether, but it just means that you can't buy it with your fiat money. And that's where we're heading now with this the rig market trading system that we have.
Yeah, I think the silver shortages, and we are seeing evidence that they are appearing now. The Silver Doctor had an article about it, with the warehouses being empty and things like that, his other contacts. But I think it depends on the price. In a free market, obviously, if the price was allowed to rise, there would be people selling their scrap silver, grandma silverware or grandma's, pride stuff down to the refiners and things like that, so it could get melted and people would recycle silver more. But at $15 an ounce silver, where basically there's covert price controls in the market, we're at a price now where there's no economic incentive for people to want to recycle silver. Maybe, if you inherited, if grandma died or something like that, God forbid, and you inherited something, right, and you just wanted to sell everything you could, but there's real no incentive for recycling or people to sell their prize silver at these prices. And we're at a level now where the miners, whether it's base metal miners or the primary silver miners, it seems to me, David, and you run a mining company, where, since 2011, the miners have been really reactive and behind the curve in cutting prices. So every time the paper gold or silver price drops, the miners try to cut costs, but they can't cut costs fast enough. They kind of catch up to the level of around the metal price, and then it drops further. So it seems to me, the last 4 years, basically, we've been in a stage where, you have Roadrunner and Wile E. Coyote, and Roadrunner's just way outrunning them, and the miners are Wile E. Coyote and can't catch them and run off the cliff. So, I mean, it seems to me the gold and silver miners, they can't cut the cost fast enough because the paper price keeps dropping due to, manipulation.
Yeah, they need to cut production is what they need to do. And they need to take production offline because they are really running on a treadmill here, trying to supply a market which has an artificial pricing structure. So they need to take the product offline. And that would remove, and the other thing they should do is not use the LBMA pricing system, where they use the PM fix on any given day to price their metal. They really do need some kind of an exchange, an alternative exchange to price their metal, and continuing to produce in this environment where we see a decline in the price of gold and silver since 2011. While we have these tremendous shortages of metal, or tremendous stress in the demand side of things, multiples of the readily available amount of metal, you're really harming yourself in terms of trying to compete in this market and allow it to continue.
Yeah, and in your opinion, are the miners, have they been, for the last X number of years, most of them have been selling their gold and silver at enormous losses, right? Because they either have debt that they owe to the banks, and the banks have basically been forcing them to keep selling, or they've hedged some of their metal, right, and they have to deliver into the hedge.
Yeah, I mean, if you look at what they call all-in sustaining cost, which isn't all-in, by the way, it doesn't include G&A, and it doesn't include the cost of interest. But there should be about $1,100-$1,200 an ounce just to break even, and that's on those bases. Then if you add in G&A and interest and amortization of their projects, you're heading towards $1,600 an ounce. So in reality, they've been doing it on a cash basis just to kind of keep their nose above the waterline, but it's been to the detriment of their shareholders. And many of them have been taking on debt and other things to try to keep going. And we've seen numerous companies wiped out by their debt. A number of them in the last 6 months, both platinum producers, silver producers, and gold producers.
Yeah, and we've also seen companies like Burack Gold, which were growing when the gold price was going higher, taking on enormous amounts of debt. And now, they have all this debt left with the lower gold price. Now they're being forced to, I don't know if they've breached their debt covenant. I haven't looked at that recently. They almost did 2 years ago. But, they're being forced to do all these deals with Royal Gold, where Royal Gold went in and got a really nice stream on one of their lowest cost mines in production. And, we're seeing the miners who did behave, who had savings and capital and things like that, didn't have as much debt, who have lower cost projects, we're seeing them start to do mergers and acquisitions now at this point, and the royalty and streaming companies are just licking their chops here, ready to do deals, because from what I've heard, with my other contacts in Vancouver and Toronto, there's really not a lot of capital available, whether it's debt or equity, for most of the miners at this point.
Yeah, manipulating the gold price and the silver prices, silver and gold are kind of like a speedometer, and they tell you how things are going, and they're an instrument to tell you how things are going, or they can look at them as a thermometer. And what they've been doing is forcing the needle of the speedometer or thermometer, whichever way you look at it. They've been forcing it to give an impression of a certain condition in the economy, and as a consequence, they haven't addressed the underlying issues in the economy, which would have been forced on them. For instance, we know that a higher gold price leads to higher interest rates, and that would have forced a write down and a rewrite of the existing debt out there, and would have prevented this enormous debt bubble from being blown. And that's ultimately what needs to happen, is that instead of attacking the indicators, we need to attack the problem, which is the debt overhang. Number one, we need a structured write down of the debt. And then we need to deal with the monetary system, which is one of we have captured by the financial industry. The players in the central banks come from the financial industry and are beholden to the financial industry. So we really need a new monetary system, and we need to get one where a group of men, more often than not, sitting in a room, can't determine how your economy is doing based upon what they deem to be important on any given day. And it's first of all, they can't do it. They can't replace inputs from the markets and from the activities of humans. And secondly, they act in a way which is not in the interest of the greater good of humanity more often than not. And we've seen that repeatedly with the rigging of interest rates in all the financial markets.
Yeah, I agree. We need to see more free markets across the board, and that'll create higher quality goods and services at lower prices. Yep. It'll create more investment in new technologies, which means new industries and things like that. I have a couple more questions for you before I let you go. We're discussing the impact of lower copper prices on the silver market, and one of my theories is that because so much of the annual silver production is a byproduct from especially base metals like copper and lead and zinc and things like that. So do you expect then that the lower copper price, as these copper miners, they brought on a lot of higher marginal, higher cost copper mines, and now the copper price is way lower, those hedges are coming off. Is that going to mean that silver is going to come offline too, and that's going to help exacerbate potential silver shortages? Yeah,
the number I've seen is I think 55% of silver production is a byproduct of base metal mining. And then another 25-30% comes from gold production. So as these, and we know that there's an oversupply of copper on the market, and given that China's electrical consumption is down now to 1.3% increase year over year, we can see that the infrastructure is not going to be required and will likely be decreasing in terms of being built. So the demand for copper will come off, and the mining will slow, and that certainly will slow the availability of newly mined silver to market. And the thing is with silver is there's very little refined silver stock that's available to market. So to pull it out of the tightly held hands that it's in, you're going to need much higher prices. And silver is the one metal which, it's not just a monetary asset and a safe haven asset when the printing presses light up. It's also a critical industrial asset which is needed by, for instance, Apple for making their phones and others. But they absolutely need this metal, but it has to be pulled out of the hands of those who tightly hold it. And for that, you're going to need much higher prices. And the problem that we have here, Jason, is that the gold and silver are Giffen goods. And Giffen goods are assets which, most assets, the demand declines when the price rises. But initially with silver and gold, the actual demand increases as the price rises because of a perception of a hot market. And so we need the price to go beyond that, which is high enough to attract more buyers into the market. And we need to actually have enough to pry the silver out of the tightly held hands, and it may mean well more than a double from current levels before we see that silver flowing in the market. But the miners are not going to be able to supply the silver that's needed by the market when the base metal mines slow down.
Yeah, and when I look at the physical silver market and I look at data points from a lot of places, I see industrial demand for silver is still pretty strong. I mean, solar panel installations are still increasing, and we haven't seen solar taken out of the panels yet, although there's smaller companies that are claiming that. But, I mean, the majority of solar panels still use an enormous amount of silver, and the amount of solar panels installed is projected to grow enormously. And we also see, silver industrial demand increasing in other industries. And then you look at the, people buying physical silver maybe for investment purposes or for monetary purposes, whether it's India, China, demand for silver is up a lot. Silver Eagle sales in the United States is still very high. So there's a lot of, there obviously I think demand is strong for the physical side. And on the supply side, I see supply problems from the primary silver miners who basically, at $15 an ounce silver, we have Pan American Silver, who was losing a lot of money, all the way down in the silver price. And I guess they've cut costs to the point where maybe they're kind of breaking even on the silver price. They claim they're all in. Sustaining cost is 14 and change now in the recent quarterly report.
Yeah.
But that's not indicative of the whole industry, how much they've been able to cut costs. So I see supply problems from the primary silver miners because all of them haven't been able to cut costs at the rate that Pan American Silver has, and even Pan American Silver wasn't ahead of the curve at cutting costs.
Yeah.
And, then I see the problems in the base metal byproduct guys with the silver too. Maybe they've sold the silver to Silver Wheaton on silver streaming agreements or things, or maybe they hedged the silver, but, those base metal mines needed much higher prices, and now there's no demand for the base metals because Chinese central planning, they don't need as much base metals anymore.
Yeah. I mean, Keith Neumeyer of, I think, First Majestic, I think he's identified the problem here with silver, that the silver producers need to pull their production until the price corrects. And the silver producers, by cutting costs, are never going to make up the amount that they lose from the artificial pricing structure. And the structure needs to be reset to a level that you have sustaining mining that covers the full cost of production. And that includes everything, and it includes G&A, and it includes interest, and it includes amortization of your capex. And these things are not being covered right now, and there's no way that you're going to be able to cut your way in terms of your production costs to the level that you can recover those other elements.
Yeah, and those mines currently have also been high-graded for the last few years, and they weren't supposed to be. So the long-term mining plans at some of these mines are in major jeopardy, right, for the mines just to survive because the mining plans have been drastically violated.
Yeah, no, they've picked out the high-grade zones, and there's very little left now in terms of the easily mineable high-grade material.
Yeah, I noticed I think 2012, I heard Keith Barron during interviews, and he's a consultant. I'm sure you know who he is. And he was saying he was going around visiting mines and things like that and talking with other miners in the industry and how, they had started high grading then when prices started falling in 2011, 2012 just to survive then. And, it's gotten even more pain all the way down. Now there's really no capital available. So, I mean, this is not sustainable because, I just don't see how the miners are going to survive when they're losing money on most of the ounces they produce and there's no debt or equity available.
Yeah. I think, Jason, we're heading towards a financial crisis here. I think, we've seen it now, the start of it, the loss of almost $4 trillion in the Chinese market and a couple trillion in the Western markets now. And it appears to be accelerating, and they've kind of used all the arrows in their quiver now, the central banks, in terms of propaganda and talking to the markets and lowering interest rates. And I think we're going to get to the point now where there's going to be a very rapid learning curve of investors out there of their true exposure to this over-leveraged system, over-indebted system, that the debt is unsustainable, and that the response now is going to be unlimited money printing to try and keep things liquefied as the assets deflate, in particular the bond market deflates. And I think there's going to be an attempt to make it gradual, but I'm afraid it's set up to be a precipitous change in the markets, and it's going to be a very turbulent time, I think, that we're heading into now, and it's going to be one in which a very, very small basket of assets, including precious metals, out of the markets and out of the banks, give people protection from the loss of wealth.
Yeah, in the West, we had a lot of people buying gold after 2008 and 2009, and then a couple years later, a lot of people dumped it, and these people weren't gold bugs or silver bugs. They don't study a monetary and financial history or read Austrian school economics like you and me. So, they were like, well, the stock market's going up. Now I'm going to dump my gold and silver, and that's what they did. But now that volatility is returning to all the major markets again, and we're seeing big upswings, ups and downs, most people are not options traders. They can't make money, trading options up and down and things like that. They don't make money day-to-day trading off the volatility. So I think the ones who are not day traders and options traders, they're going to put more of their money from other markets into gold and silver. We're going to start seeing capital flows go back into there, maybe in physical gold.
Yeah. I might add that personally, I agree with that, but I think that the big question mark here is the markets. And is there going to be a discontinuity? Will the markets be suspended? Because I think they are so distorted. It's going to be tempting to shut them down in order to preserve them for the future in a way that maintains the interests of those who benefit the most now. And that's the big question for me. The question is, I don't know
if they'll shut everything down, David. Maybe, like in China, they tried a large amount of intervention. Maybe what we'll see here in the United States is like some type of banning of short selling of the home builders or the banks, preferred groups that Congress likes for central planning reasons, or they donated more money to Congress or things like that, or, we may see that where preferred companies or preferred industries get preferential treatment, banning short selling or things like that.
Yeah, well, they've well and truly monkeyed with the system now, and there's so many distortions, and they compound. It's not a linear impact on the market that you have when you start intervening with the machinery of its operation, and so you get things which you can't even predict all of a sudden cropping up. And I think that it's an exponential level of complexity that you have when there is market intervention. And I think we're going to start seeing the consequences of these interventions and the compounding seriousness of the impact on our society as these distortions work their way out of the system. So it's really, nobody knows what the future holds, but I can see that we're going to have a turbulent time here as we try to bring the list out of the ship.
Yeah, I completely agree. The Keynesians think, and the politicians think that if they increase taxes 10%, they'll get 10% more revenues. But as an Austrian school economist, we know there's unintended consequences to that action. Yeah. That it's going to force businessmen and entrepreneurs and investors to either move their money out of the country or look for a gray market economy or all these different things that the central planners weren't planning on. So that they're not going to get all these things that they're planning on doing. My final question for you, David, before I let you go, is about the China gold reserves. Were you surprised that China announced only a 1,600-ton update to their gold reserves?
No, because I think they want to continue to accumulate gold. And if they had announced a 10,000-ton holding, it would have had a dramatic impact on the markets, and the markets would have dried up. So it's in their interest to extract gold from the West as long as possible. And so, you talk up your book once you've got your book established, and there's still more gold to be had. I mean, in July they got 302 tons out of the system. That was delivered through Shanghai, plus whatever they're pulling out of Beijing directly into the federal government coffers. So it's very much in their interest to understate their interest in these assets. And I think they will continue to until it's in their interest to reveal how much they really have. And I think that's what happens once they've remonetized the asset.
Yeah, I'm really surprised they haven't started, going around to mines in Canada or Brazil or these other countries and saying, well, maybe you won't allow us to buy 100% of the mine, but we'll buy 50%. So here's 50. We want 50% of this mine. We want 50% of that gold mine. We want 50% of the silver mine. I'm surprised we haven't seen that yet. But
well, they're doing it in places like Africa. I mean, they're going through and buying enormous numbers of mines and enormous positions in mines, and but I think that they're very subtle in the way that they do it, and it's very much going on out there right now. They're just not chasing Goldcorp, and because they know that that's going to flag their interest in these assets. So they do it subtly and they do it privately, and it's very much a trend that's underway. It's just not seen by the retail trading public, and it's not being written about in the press. But it's very much an artifact of what's going on out there right now.
Do you think they're also not announcing this number too, so that they can stay in the U.S.'s good graces, kind of to hedge their bets and still sell their goods to the U.S., and so that way they can be allowed into the SDR, the RMB gets in there in the next year or so?
Yeah. I mean, they're getting $30 billion a month in excess, in a trade surplus with the states. So, they're netting $350 to $400 billion a year there. They're getting technology transfer, but I don't think that ultimately that they're particularly hoping to maintain the graces of the United States, because I don't see them as thinking that they can maintain that relationship over the long term. I think that China really is interested in accumulating as much of critical strategic assets as they can while they can, so that they can restructure their economy and right their ship of state once we head into this new economy after the correction.
They're obviously printing RMB too because they have dollar pegs, so it's not like they're behaving super well. It's not like they're using free market economics either. Because they have trade surplus, they're actually producing goods and they're buying commodities. They're probably in better shape than many other countries at this point.
I don't think that they particularly value the free market. I think they're just able to gain a lot of things from using it right now. And we'll see what kind of a hybrid system comes out of China in the future.
I just want to thank you again for your time, David. How can our listeners follow more of your work?
It's posted on safehaven.com under my name, typically, and also 24 Hour Gold over in Europe and a few other places. So that's probably the best way to keep in touch with the posted interviews with the discussion notes and links that follow.
Very good, and we'll have you back on again when there's more developments in the gold market. Thank you again for your time.
Great. Thanks a lot, Jason.